I'm Sebastian St. James. Last year was a terrible year on the stock market. This is the All Ordinary So Australia in 2022. As you can see, it was up, down, all over the shop, and it finished at 8.895% down. This is the S&P 500, so the US stock market. In red, it basically followed the Australian one, didn't it? Except it went worse. It finished minus 19.953% down. And in orange is the Nasdaq 100, which, that even went worse. What is going on here? Minus 33.706%. Terrible, terrible, terrible. That's an F on your report card. The question is, now that we had a bad year last year, does it more or less follow that we're more likely to have a bad year this year? Bad follows bad. Or is the froth gone out of the market? And a bad year last year leads to the probability of a good year this year. That is a question I can overwhelmingly answer for you, and you will be impressed with the results. To reach that conclusion, we will need some serious data. Lately on my channel, I've been building the Market Simulator Mark II, and I've been collecting massive amounts of raw market data. And that data alone gives me everything I need to know to predict what's going to happen with this year. And I'll show you exactly how. Step number 1, find the opening price for each year. So here's the All Ordinaries, or the Australian stock market. We go all the way back to 1984, where the market opened at 706, and the next year it opened at 721, 1003, and so on down the list. So why am I using the All Ordinaries rather than the S&P 200? If you're 12, you probably think the S&P 200 has been around forever, but it hasn't. It's a much newer index. So if I want to look back at the history of the Australian stock markets, it's All Ordinaries all the way. Step number 2, find the closing price for each year. So I've gone ahead and done that. In 1984, the last trading day of the year, the market closed at 726.1. The next year, in 1985, it closed at 1003 and 1473, and so on down the list. So far, we had the very beginning of each year, and now we've got the very end of each year, except if the market went down, then they're kind of the other way around. Now we can subtract the two and figure out how much the stock market went up or didn't go up in each year through the entire history of the market. In 1985, the stock market opened at 725. It finished at 1003. Subtract the difference is 278.7. That's what the market went up for by that year. But what happened to 1984? Weren't you showing me data for that? Yes, but our data actually does not go back to January. It comes back in part way through the year. We're looking at full year results here, so 1985 is our first full year. In the next year, the stock market went up by 469, down by 157, up by 168, and so on down the list. If you like, we can take those differences and I can color code them. Green means good, and that's when the market went up. Red is the down years. We can simply count them up. How many ups and how many downs over the entire history of the All Ordinaries. So here's your answer. The All Ordinaries has gone up for 27 years and down for 11 years. Interesting. Step 5, work out what percentage are up years and down years. So with the All Ordinaries, we find it goes up 71% of the time and it goes down 29% of the time. Or if you like that in English, the All Ordinaries has a 71% chance of going up in any year over its entire lifetime, which is massive. So we know that the stock market has a positive expectation, which means it's more likely to go up than down, but it's not like a 55%, 45%, 55% good, 45% bad. No, look at the figure, 71%. Whew. Perhaps Australia is just the lucky country. What about the US? Well, this is the SPX, or the S&P 500 index. We go back to 1928. We find the first year went up by 6.59. 6.59 what? Well, index points. That's all it is. This is not dollars. This is not percentage. The next year was a down year at minus 3.35. Down year and then a down... Whoa, lots of down years there. What's going on? Sad but true, the S&P 500 in its early years did have a lot of down years, and as time has come more recent, not so many. So I've counted them up. The S&P 500 has had 63 up years and 32 down years. So it's a little bit more even than the All Ordinaries, giving it a 66% chance that the market will go up in any year, 34% chance it will go down. So if Australia has a 71% chance of going up, the US market only has a 66% chance of going up in any year. Does this mean that Australia is better than the US? Of course, in every possible way. This is actually measured over a different time period because the S&P 500 has been around longer than the All Ordinaries. So the All Ordinaries has been from 1985 right up to the end of last year. The S&P 500 from 1928. It was those early years when things went worse. But there you go. Even if you look at that time difference, which is absolutely massive, still 66 versus 71, they are within the same ballpark. What about the NASDAQ 100? What has it done? First, there's somebody I need to thank. In a previous video, which was actually the video Protect Your Wealth, Hedged ETFs versus Unhedged, the risk of getting it wrong. Wow, I must rewatch that one. David said thanks, and he's got 2 little beers or eggnogs. A Christmas gift from David. Thank you very much. I'm jingling all the way as we speak. In a different video, which is the Why Dividends Are Bad and Don't Matter video, hey, that's a very good one. David said specificity. What did he mean by that? You're going to have to watch the video and find out. Not only did David give me a Christmas present, he also gave me a New Year's present. So thank you very much, David. So if you'd like to be special like David, you can hit the thanks button below this video. This is the raw results of the NASDAQ 100 each year. So in 1986, it went up by 9.11 index points. The next year went up by 14.84, next year 21.16, and so on down the list. I can see, well, not too many negatives, but a couple. So I counted them up. It had 30 up years and it had only 7 down years, which gives the NASDAQ an 81% probability of it going up and 19% probability of it going down in any year. People think that the NASDAQ is much more volatile. That's good because it is relative to the S&P 500, but statistically has the greater chance of going up over its history, which is quite interesting. So here it is. The All Ords has a 71% chance of going up over its entire history. S&P 500, 66%. The NASDAQ 100, 81%. So there you go. The question is, what is the probability that the stock market will go up in Australia this year? The answer is 71%. I mean, that's the historical average. That is if, and only if, every year you wipe the slate clean. January 1, you think, what's going to happen with the stock market this year? What happened last year? Doesn't matter. Every year is a new year. But that is not how the stock market works. The stock market has a memory. This is Simon. Simon loves flipping coins. If you're under the age of 30, you've probably never seen real money, let alone use it. You probably just tap, wherever you go. Beep. So this is what you need to know about how coins work. If you're flipping a coin, the probability that you'll get heads is 50%. The probability that you'll get tails is also 50%. Simon is flipping 10 coins in a row. Flip, flip. Oh, what an exciting pastime. How has Simon actually gone? So far, Simon has flipped 9 heads in a row. Wow, that's impressive. And no tails. I'm suspicious about this coin. Now, remember the probability is 50%. So if Simon is going to flip 10 coins, we'd expect 5 heads and 5 tails on average. The question is, given that Simon has flipped 9 heads in a row, is Simon more likely to flip tails next time? There will be a division. Some of you will know what the answer to this question is. Others will make an assumption and actually get it wrong. So what is the answer? If I've had a run of good luck and spun a whole lot of heads, surely to balance it out, then I'm much more likely to spin tails. The answer is no, that is not how it works. A coin does not have a memory. Sure, on average, over a long period of time, it'll be about 50-50 on the splits. But on any given throw, the coin does not have a memory. It does not know that it spun heads or tails last time. It's impossible for that coin to change its probability. It's always 50-50, regardless of the run in the past. This is Penny, and Penny's a bit of a slapper. The first time that Penny slapped Jim, he had a 20% chance of reacting. The question is, if Penny's going to slap Jim a second time, will that percentage chance of Jim reacting remain at 20%? No, because Jim knows what's coming. Slap me once, shame on you. Slap me twice, shame on me, because I know what's coming. Jim has a memory. The question is the stock market like a coin with no memory? So every single year it's brand new, has exactly the same probability. Or is the stock market like Jim? It's got a memory. Last year was a bad year, therefore I know about that and therefore I'm going to react this year differently. To answer that, we need to know what makes up the stock market. The stock market is not made up by flipping coins. It is made up by flipping people. And they definitely have a memory. Oh, the stock market is going up. Buy, penny stocks. Yes, where can I get them?
What is the latest stock on Reddit? Yes, I must put all my money into that stock. Ding ding! Oh no, the stock market is going down. Quick, go to gold. Do not trust fiat currency. Gold is the only thing you can trust. Dig a hole and put your money in it.
So if the stock market dropped last year, which in fact it did, there is no way that this year is a clean slate and people do not remember what actually happened a few weeks ago. So given that we know that every year in the stock market is not a blank slate, it is not like a coin, then we have to factor that in. And this is how we do that. So what we want to calculate is the probability of the stock market going down, given, which is what that vertical line is, that last year the stock market went down. Well, how do I do that? Well, it's really quite simple. I already have a list of all the years that went up and down. So I just simply find the years that went down. I ask the question, the next year, did the stock market go down the same as the previous year, or did it in fact go up? And I simply count them. So here it is. This is the all ordinaries. We see the stock market went down by 384.5 points. Did the next year also drop? The answer is no. The next year went up by 330.5. The stock market went down by 2,759.3. What happened in the next year? Oh, it went up as well. But when the stock market went down by 30.8, the next year it actually did go down also. Aha! So I went down the list and figured out when a bad year actually begat another bad year, and then I simply counted them up. And here's the answer. In the history of the All Ordinaries, there's actually only once when the stock market actually went down, and the very next year it went down as well. Which is extraordinary. I certainly would have never assumed it was that rare. So far we've had 11 down years, but of course, this year is a down year and I don't know what's going to happen next year, so it's really out of 10. So 1 divided by 10 is 10% chance. That means in the history of the All Ordinaries, the Australian stock market, whenever there's been a bad year, the probability that there'll be a bad year next year is only 10%. 90% chance you'll have a good year following a bad year in Australia. It's quite extraordinary. In the S&P 500, there were 32 years, of course we're counting 31 of those, and only 9 of those where there was a bad year did another bad year follow, which is a 29%. If the US market went down last year, there's a 71% chance it will turn around and go up. Those odds are pretty good. And the Nasdaq, I counted 2 years where the market went down in a row, which is a 33% chance. Now, it doesn't guarantee what will happen in any one year, but that is the average probability over across the entire market. So the All Ordinaries, the Australian Stock Exchange. The probability it will go up in any year is 71%. However, if last year was a down year, there's only a 10% chance that that will repeat. The S&P 500 has a 66% probability it will go up in any year. If last year was a bad year, there's only a 29% chance that that will repeat. The Nasdaq 100 has an 81% chance of going up. If it's a bad year last year, the probability of that repeating is only 33%. Okay, it is time to draw some conclusions. The market is more likely to go up than down in any year. That's the positive expectations. That's why we invest in shares in the first place. If that wasn't true, I wouldn't be investing. And mostly, a down year last year leads to an up year this year. So there you go, there's your answer. Bad year last year, a fairly high percentage chance it'll be a good year this year, but of course, that's not written in stone. Do you know there's an ETF that actually will make you richer than the Nasdaq 100? Wow, that's a video I'm going to watch, or if you've already seen it, click here.